Hello, everyone. Welcome to the market update here for Tuesday, January the 10th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry, Jerry, at TradersPro.com, and I'll be happy to answer those for you. Before we get started, the stock-specific class I did last week, Thursday, there was a clicking that was in the recording that was really bad, and I don't know if you heard it on your end. I can't hear it on my end. I know it's come in a few times. I've had a few people bring it up. I don't know what's causing it. I'm going to here eventually try a different headset to see if that fixes the problem, but if you do hear a clicking, can you let me know? I can try to dial back in on the audio and see if that fixes it. But let me know if you're hearing that on your end, because I know it can be annoying. And like I said, I can't hear it on my end, so I'm going to rely on you guys to let me know. So sounds like there's no clicking going on right now, so that's good. And so let's go ahead and start. All right, so lots happened since Thursday. The jobs report came in. I was kind of expecting the jobs report to be a catalyst for the market start selling off. It didn't. It rallied. Although I did point out in those classes last week, we were, we'll get to the chart here in a second, but remember the chart, the market's been in a corrective mode for the last few weeks, and it's correcting that initial move down in December. And so once that corrective move is done, we should head lower again. But the rally on Friday, reversal we had yesterday, kind of pushed us into really as far as I want to go as far as that resistance area. I'll show you on the chart here in just a second. But I'm wondering if maybe the CPI report this week will be a catalyst for the drop, and it may not drop. You can't know exactly what the market's going to do, and sometimes it's going to make moves that don't make sense and don't fit into the chart pattern or the trend sometimes. And as trend traders, we've got to adapt to that. We don't want to dig in necessarily, but the market taking off right here would not make a lot of sense to me as both from a technical standpoint and a kind of a fundamental standpoint as far as the way I see the what the Fed's doing in the economy in general right now. So, but there again, like I said, I've been doing this a long time, and there are definitely moments where the market makes moves that don't make a lot of sense, and you have to just kind of adjust with it. All right, the direction alerts, still in a bear market. Again, that's important to continue to recognize. Markets, when you're in a bear market, what happens is that the rallies within the bear market, you sell the rallies. You expect the market after these rallies to continue to move lower until that behavior changes. When you're stair-stepping up in a bull market, you tend to have these impulsive moves up, and then when you pull back, they tend to be more choppy and corrective on the pullbacks. And it's just the opposite when you get into these bear markets or these downtrends. You get impulsive down, and then you get these weak rallies that look a little bit choppy sideways. They struggle to rally, and that usually leads to bigger declines. Now, this is just kind of a basic, outlook of trend behavior. What do you look for a bottoming process? Well, one of the basic things you could look for, and sometimes it's a little bit more complex than this, is that you get an impulsive move down, usually a panic sell-off where people start to wonder, man, how much further is this thing going to drop? And then that's followed by a sharp impulsive move up. Then you start to get back into this behavior over here, that bull market behavior where you have impulsive up, corrective on the pullbacks, impulsive up, corrective on the pullbacks, and it starts to stair step higher, higher highs, higher lows. Now, sometimes when you have major bottoms that take place, you can have kind of a basing type of behavior where you might get an initial impulsive down. One of the key things is you get that panic sell-off near the bottom there. It doesn't have to be the final drop. Sometimes you'll get a panic sell-off and then you'll even go down further, but the next move down isn't as panicky after that. We saw this happen in the financial collapse in 2008 going into 2009. Some of those sell-offs in 2009, they didn't really spike a lot of fear in the selling. Now, a lot of that came earlier, but it did happen. You want to see that. We haven't had that during this whole decline over the last year. We have not had a panic type sell-off where everyone's wondering, man, how bad is this going to get? And that's usually what you want to see. Every major bottom has had it. And that's why I'm still looking for it. I don't trust these rallies until we get it. Now, could this be the one time that it doesn't happen? Yeah, I'm open to that possibility. But there again, if you start opening up to too many possibilities, then you lose focus of probabilities. And the probabilities are what's most important is sticking to the probabilities as much as possible. So, but you can get that initial reversal, and then you kind of can base a little bit right here, and then start to move back up. You get more of a bowl-shaped move type of bottom. Either of those could start to take place when you're at a bottom. Again, the key is to wait for that panic kind of sell off, and then you start looking for more of a bottoming process to start to take place. So if you've joined me in the particularly the last 8 months, and you're tired of how bearish I am, and you wish I would be more positive on the market and all that stuff, this really doesn't have anything to do with being positive or negative, because you're equating bear markets as being negative and bull markets as being positive. It's really not the case. They're not. Bull markets aren't necessarily good and bear markets aren't necessarily bad. It's just part of the cycle. And if you get too caught up with, you're being too negative. Well, no, I'm just trying to understand the trend behavior, make sure I'm on the right side of that behavior. And because it doesn't do you any good to be positive and be a cheerleader wanting the markets to go up and then lose your whole trading account as it keeps trending down because you don't know how to recognize trend behavior and recognize the actual trend of the market or how the cycles play out. You don't know about panic sell-offs signaling a potential bottom. That means you're usually probably the one that's panic selling and creating it when it happens, because you don't want to see what's actually going on. So it doesn't have anything to do with being positive or negative. It's just trying to understand the behavior and the charts and trying to stay on the right side of the probabilities as much as possible. So we're still in a bear market. Momentum, we're right in the middle, so we're just still trending, which means in this case we're in a corrective period right now, so we're we're moving sideways, but the trend has been established to the downside from that move in December, that initial move down, and so we would expect that is going to continue. Now, what you'd look for is if it does start to sell off, do you start to get into this extreme reversal risk range? Because if it does sell off, it would move to the left here. When you get into this range, particularly the far left side of this range, that's where you're at a point where that sell-off is probably close to being done, or at least a pause in the selling, and you might get a rally. So you get that impulsive move down or impulsive correction, you get impulsive down. You get into this far left side of that extreme reversal risk. Usually that tells you you're probably about to do another corrective move, meaning you're probably going to rally up a little bit. Doesn't necessarily mean that you're going to go into an uptrend, but that the downtrend is stretched. These are telling you, it's like a rubber band. These indicators are telling you, are you stretched one way or the other? Are you oversold or are you overbought? And right now we're right in the middle, so it's not telling us that we're in an overbought or oversold state, which means that if the market did start to sell up, there's plenty of room for it to drop, and there's plenty of room for it to rise if it's going to rally significantly. It could suddenly take off and really make a substantial move higher, and then in that case, this indicator would move to this side, and you'd be looking for an overbought condition if it got to that far right side. So that's how you're reading these indicators. Sometimes they're not telling you anything significant. Right now, they're not telling us anything significant except that the market should continue to trend in the direction it's moving in. Same with Brett, still right in the middle here. And again, what's bothered me this whole time is that sentiment is still stuck on this far right side here. There's been no fear in these sell-offs. Even the sell-off in December, there was no fear in that sell-off, at least from a calculation point of view. I'm sure there were some people that were fearfully selling. I'm not suggesting that there was absolutely no fear by anybody. But as far as the big institutional traders, which are the ones that truly move the market, they weren't concerned about that selling. And I think they should be getting more concerned with the way the charts are behaving and the way the economic conditions and the Fed is behaving. We'll see. It's just it's kind of crazy right now. The buy-sell ratios, they've switched now where some of the buys are outpacing the sells. That is a little bit more of a bullish type of behavior, which would reflect, the market moving a little bit higher recently. We're not stretched, though. We're not at an extreme level. And even this level that we were at recently was not overly stretched or overly extreme. But this tells us that we could continue to rally a little bit further here based off of this until it got a little bit more extreme, or it could reverse right back down, kind of like it did right here. And we could start to see the sells outpace the buys again if the market started to sell off. So again, this is not really telling us anything significant. Same with this sentiment indicator. We're right smack in the middle of the range. This is the overbought range. This is the oversold range down here. We're right in the middle. Again, we could go either way. This indicator is saying we can go either way. So now what we want to do is look at the charts, see what the charts are telling us. And yet last week I pointed out here on the S&P chart, we had been moving sideways. And I suggested that, once the sideways move is done, we should continue to move down. The problem is knowing when that sideways move is going to end. You just can't know it for sure, and so you have to just kind of wait. And so that's what made it difficult. It's hard at that point to say, okay, boy, the next day or two we're gonna move lower. There was really nothing that could signal that or was signaling that in the middle of the sideways range. Now, what happened so I pointed out a couple of areas last week. One was the 389 area. I've been watching. There's been a significant amount of support or reversal support resistance in that area. That kind of lines up with this little trend line through here. Oh, that's a terrible drawing of it. Let me try that again. And then there's this little area right up to here that's at about, it's right in between 393 and 394. We'll just say 394. So, I don't like to necessarily look at exact spots for support or resistance. I like to look at support or resistance zones or areas, just because, although, again, you can see some of these support resistance areas, you can see the market go right to the penny to that spot and then reverse. You kind of saw it right here on yesterday's intraday high. It went exactly to this support area that was formed um, back in late November, early December, right into here, and then reversed back down. But this is kind of the resistance zone right here. Now, you could also throw in there that this zone is right at about a 50% retracement of this drop from December. So we have this. This is an impulsive move down. Notice how the market dropped sharply through here. That's an impulsive move. You can be impulsive down or impulsive up. It just means that the market is moving sharply in that direction. This is more of a corrective move that we've seen lately, right into here. And then this zone is right at about a 50% retracement of that entire drop. Now, that's significant. Stocks tend to retrace about 50% of their moves. So as long as we're retracing to that 50% area, it's not that big of a deal. You start to get above 50%, particularly above 61.8%. These are Fibonacci numbers and ratios that are significant in the markets. Then the probability. So if we start to get above 400, let's say, that would be above that 618 retracement level. And at that point, the probabilities of getting a decline start to diminish. It becomes less likely you're going to get that next decline and more likely that the market could rally at that point and maybe go higher, break above these highs right here. Okay. And so what happened on Friday didn't bother me at all because, that I was talking about there could be a C leg that pushes us into this 389 area, wave A, wave B, wave C. And I thought that was just happening. We were pushing into that area there. Yesterday had me a little bit concerned, though, because we gapped up at the open. We traded all the way up to the top part of that resistance zone that I'm looking at. And I'm thinking, boy, we start pushing up higher from here and you've got to start to look at it less from a bearish standpoint and more from a bullish standpoint, which, again, I'm willing to do, but again, it doesn't make a lot of sense because it doesn't fit within that impulsive corrective type behavior of the trend. You have this impulsive move down, corrective, you should have another move down. I tell you all the time, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. And that would have fit that's what fits the behavior right now, is it should have that other move down. Now, what happened after that early rally is we reversed, came all the way back down, and I'm going to zoom into a 6-minute chart, or not a 6-minute, 3-month chart here to get a little bit more detail in this we can look at. Are you? There's a question here, a cup with handle. Are you talking about the current behavior of the market being a cup with handle, like this right here? Is that what you're suggesting? If that's the suggestion, it's possible it could, but in order for this to be a cup with handle, which would be a bullish formation, it would need to come up to this area right here to form the cup, and then you need to have the handle. It would tend to move more sideways right there, and that's definitely possible. That's something you could look for especially if you're more bullish on the market. But from here, no, it's too early in the behavior there to look for that just yet. Now, I would also argue that you gotta keep in mind too, some of the larger term trends. What we've been looking at. I gotta go to the 2-year chart. You got to keep in mind this declining trend line right here. By the way, that would be something that would cause me to be a lot more bullish on the market, as if we broke above this trend line and held it. It hasn't been able to do that during the whole decline for the last year. It has not been able to hold that. Now, it opened higher. This was that CPI report that came out in December. It gapped above that area, but it closed back below it. It reversed sharply after it gapped above it, so it didn't close above it. If we closed above that trend line, well, you think about it. If we closed above that trend line, and then you'd have, that would look more like a cut pattern. Might get a little bit of a handle. Yeah, you could start to add more, bullish outlook at that point. Break above that trend line, a little bit more of a cupping type formation. It would also mean that would be a higher low. And if you went to a higher high right here, it would be behaving more like a trend reversal or an uptrend. But there again, I would come back and say, okay, where was your panic sell-off? Okay, because the problem there, and this is why I want to just get this panic sell-off over with, because what happens is it just creates more uncertainty. You're not going to be able to trust the rally because it would be the lower probability outcome. It would be the one time we've had a major market bottom without a panic sell-off. Is it possible? Yes, but can you see it'd be hard to trust the trend, because what I would be thinking is at the whole time, if it broke above here, is okay, well then what if this is just wave A? This pushes higher up into here. Yes, we get a bullish move for a few more weeks, maybe even another month or so, but that's just wave B. And bam, we get crushed with a massive move down for wave C. That means that it's just prolonging the bottom out probably another 8 to 10 months. And so now, again, this is me just wanting to get it over with and wanting the market to do what I want it to do. But, that's why sometimes it's better just to hope to take care of it right now. This ties back, by the way, into that whole inflation argument, because I understand what's going on, and I can't figure out. I know it's human nature. Remember, human nature, you'll do anything to avoid pain and to seek pleasure, right? Those are the two driving forces of almost everything, every decision, everything you do in life. The path of least resistance is to avoid pain and to seek pleasure, okay? So obviously, if the economy slows down, unemployment goes up, poor people are out of work and they're struggling to survive, rich people can expand and make even more money because you're in a contracting environment. Nobody likes bear markets or recessions, okay? Nobody. So it's natural for anybody to want to avoid that. So we want the Fed to take the foot off the gas and not go through that pain. The problem is inflation's also a pain. Inflation lasts a lot longer. It's harder to get rid of than pulling the market out of a recession. The Fed pulls the markets out of recessions all the time. It knows it can do it. It hardly ever knows if it can get rid of inflation, because again, the problem is when you mix human nature into this equation, what's all the talk right now? Everyone says, oh, look at the data, look at the numbers, everything is showing inflation is coming down. Take your foot off the gas. But guess what happens? As soon as Powell takes the foot off the gas, what happens? Everyone goes right back into spending again. The economy takes off and inflation takes off again. And then what you do is you prolong it down the road. Now you have to do it all again, rate hikes again. And now you're pushing this problem out another year. This would happen in the 70s. As soon as it felt like inflation was under control, we were having and I don't remember it because I was too young to remember it, but what happened was it just kept coming back around, and they had to keep dealing with inflation again. We had a whole decade of dealing with the whole 70s has been characterized as dealing with inflation, and Chairman Powell's trying to avoid that. But the only way to do it is to get everybody to the point where you're afraid to spend. You're afraid to go on that trip or plan that trip because you just don't know if you're going to need that money for something else, whether it's survival in some cases for some people, or just not wanting to deplete your savings or something like that, or to there has to be a psychological change, and the only way that creates that psychological change is pain, right? You got to make the pain strong enough to where when he takes his foot off the gas, people aren't ready to jump right back in and start spending again. So again, even if Chairman Powell gives in and says, "All right, we're not going to talk tough anymore," and we get this push higher, it's probably going to be a wave B. We're probably going to see inflation numbers start to pick up again, and then you've got to start all over. And maybe that's what it's going to take to create the panic sell-off. Is maybe it does have to break through and the market has to take off again, and the Fed has to realize they just got to completely crush the economy to deal with it. I don't know. That'll show up on the charts, but I'm telling you, if we break out, that's not going to be a good thing. I just don't see how it's going to be a good thing in the long run. If it is a bull turns back into a bull market, it'll be probably one of the shortest bull markets. Because I just don't see how this is. By the way, usually a lot of these things, these economic things, unless you've been to business school or you've learned them, they don't always make sense. I know politicians don't get it. I go back to the whole California debacle where, because of the pain of inflation and people having to spend more money on these products and they're stretching their budgets. They can't afford to fill their gas tank. So what does California do? They send everybody a check for some money to help deal with the hardship of their budget being stretched. Well, that is making inflation worse. They don't understand the economic principles involved. But that's human nature. That's what happens a lot of times. And that's what creates these patterns, by the way. That's why I love charts, by the way, is that the charts cut through all the BS. The charts reflect all the human nature that's going into these decisions. It creates that stair step, that impulsive corrective behavior that we see on these charts and these different chart patterns that play out. In fact, if we zoom in to that 3-month chart, that's what happened yesterday. You get this bearish reversal candle yesterday. It started to rally, came all the way back down, closed at the lows of the day. That is a bearish reversal. Now, today we're right back up challenging that. Now, I'm not too concerned. Sometimes you'll get this little fight the next day. What's going to be significant here is the range of yesterday. And I talk about these price ranges of the day before. Because the high of yesterday was right in our zone. Here's our resistance zone right through here. A breakout above here starts to now challenge the retracement of that move down, and it brings into play maybe this is a little bit more of a cut formation, all that kind of stuff. But this is kind of that critical spot. Now, it may be that the market's just trying to hold until Thursday. That CPI report comes out before the market opens on Thursday. Then you've got earnings coming out. The bank earnings start on Friday and then go into next week. We start to see some of the tech companies report. That's another thing, is that we haven't seen any companies really lower expectations yet, at least in any sort of dramatic way. That's something that Chairman Powell wants to see at a minimum. It'll be interesting to see. There's plenty of catalysts going forward. Either way, it could be catalysts that could push the market higher or lower. The chart pattern, though, at least as of right now, is indicating that we should get a decline out of that. Now, when that happens, like I said, you see the pattern, you start to look for triggers that could cause it. Definitely yesterday's reversal was significant. You don't see these bearish reversal formations very often, and especially when they happen, in this case, after the tail end of a corrective move right here. I thought for sure the market would be lower today just off of that reversal alone, but I've seen enough of these candle formations where sometimes it fights it the next day. And so it'll be interesting to see how we close. Remember, yesterday we closed, we faded quite a bit into the close. If we fade off the highs quite a bit today, I think that will, it's to where it's more of an indecision candle. I think that would increase the probability that at least we move lower tomorrow. But there again, Thursday is a key day, so we could see some sideways movement until Thursday. But I would expect, although again, I expected the jobs report would trigger the drop, especially since on Thursday here, here's our range on Thursday, Wednesday. Thursday, remember we were closing below that range. That was a bearish close that we had going into that jobs number. And it could be that we get what we got back here. Same thing happened back here where we were moving sideways after this decline. That CPI report came out. It opened way up here. It looked like the market was just going to explode, and then it reversed sharply. Maybe the same thing happens again, throwing some traders off. I don't know. We'll see how it plays out. It's just all I would say is that the probabilities right now are lining up for another move down, and so that's how I'm playing things until I see more evidence that it's not. Yeah, I'll talk about gold here in a second. Yeah, gold gold's a little bit stretched in the near term. I wouldn't be jumping into gold right here, but I do like all the charts of the gold stocks. All right, so let's move on. The other indicators, I'm not going to spend too much time on these because they're showing kind of a similar thing. Here's the Dow chart. Again, it had the bearish reversal candle yesterday on there as well. Corrective looks like a bearish. Pretty distinct looking bearish ABC pattern right here. Trying to fight it a little bit today, but now it could be that this is wave A, this is wave B, and then you get in this, maybe on the Dow chart it gets down here, and then it takes off again. I don't know. It's hard for me to believe that the Dow is going to take out well, it could. If we have a really panic sell-off, the Dow could possibly take out its October lows, but the October lows on the Dow are way down here. It's a little bit more realistic to expect the other indexes to break below those. All the other indexes should break below those October lows on the next major sell-off. The Qs are again showing a little bit of strength. Qs and the Russell 2000 are showing a little bit of strength today, but it still looks like a C leg of a bearish ABC pattern. We had the bearish reversal candle yesterday. What's going to be important is to watch that range from yesterday. In the next day or two, if we close above that range, you have a little bit of resistance here. And to be honest with you, the NASDAQ, even though it had that bearish reversal candle yesterday, the NASDAQ could get up into this area and still be part of a bearish correction. Like I said, you've got significant resistance here. You're not above that, significantly above that. That'd be about where the 50% retracement level is of that move down. You'd have to get up into this area right here to really show a potential bullish outlook at that point. Russell 2000. Now the Russell is challenging that intraday high from yesterday, that bearish reversal from yesterday. And we'll keep an eye on that at the close. And a lot of that's coming from, there are some stocks that have just gotten completely beat up. A lot of the stocks that were flying high during the COVID, Carvana, it's on the verge of bankruptcy. But some of these stocks, they're beaten down so much that that people start speculating again on them, and they'd start jumping. By the way, that's usually not a very bullish sign. And that's definitely not what Chairman Powell wants to see, is people speculating in some of these beaten down high flyers from the COVID area. That's just showing a risk on type of behavior, which is what he's trying to crush right now. So that's where it gets weird, because it's like what you might think is good is actually bad. A lot of, in these situations. But if you know what's going on, if you know what he's trying to do, then it's easier to see what's going on when you know that why he has to do what he has to do. It's like a bunch of spoiled kids right now. They what do kids want? They want you to feed them candy, right? And they'll throw a tantrum until you feed them the candy, but the candy is not going to do any good. It's not what they need. But you're tired of the tantrum, right? And so you give in and give them the candy, right? Or you don't. And that's what Chairman Powell's trying to do. He's got all these screaming, spoiled kids wanting him to give them the candy. And he's saying, you guys, that's not what we need right now. What's best is we do this, but the pressure is building on him to give in. And if he gives in, it's just going to prolong this out a lot longer. Bond market has been tough to read. We broke this long downtrend on this impulsive move up right here, and then we had this kind of impulsive move down. You could make an argument that this is a little bit kind of choppy through here, coming down a little bit today. Could this be a correction? You're right at about a 50% retracement of this move down, and then we're starting to turn lower. Could it be that this is definitely impulsive move down, and this is a correction of it, and we're going to head lower? You could also flip that and say, well, why couldn't this be a 50% retracement and we're going to go higher? So the bond market is just not giving us a clear direction. I talked about this for the last week, a couple weeks actually, where I've said, what I'm looking for is that kind of impulsive corrective alternation. And when you don't get that, when you get impulsive up, impulsive down, and this, you can make the argument this is looking still a little bit more impulsive to the upside here. It's just that you're getting indecision in a wider range. You're getting these impulsive moves that ultimately are moving sideways, but they're not really helping you in the near term with that trend direction. So hard to kind of read the trend of bonds right now. There is a higher low right here, so obviously if we rally higher, we break to a higher high. That would be more bullish for bonds. If we reverse right down here, we break below this low, that would give you a lower low and a lower high here. That would be more bearish for bonds. We're kind of stuck in no man's land right now, so I'm not going to there's really not a clear call on that direction, except for the fact that we could be closing below the low of the previous day for the first time during this whole run up right here. If that holds into the close, and that would be a little bit more bearish for bonds in the near term. But again, not a lot to go on there as far as the overall trend direction. Gold, like I said, is in a nice strong uptrend. I'm holding gold stocks in the portfolio. That's the only thing I'm holding right now. But this is where you can use your extreme reversal risk tools. We're at the far right side of that extreme reversal risk. Doesn't mean that gold's going to go into a downtrend, okay? What it usually means in this context, when you have a nice clear uptrend, is that it could start to correct. It could start to pull back or move sideways for a little bit. And so you wouldn't want to enter in. I don't like to enter in. I mean, you could always do whatever you want. If you're not worried, if you're taking a much longer term outlook and you don't care about a better entry, could you enter there and put a stop all the way down here or something where you give it plenty of room to pull back? But I just don't see. I personally just don't see the point in it, because the probability is it's probably going to consolidate or pull back a little bit why not wait for that? Especially if it comes back, it can give you a little bit better entry price. But and it's not, is there still room for it to still go a little bit higher here? Yeah, it could still push a little bit higher in the near term. It's kind of paused a little bit the last couple of days in that overbought state. So the trend is clearly up. I do like gold. I like gold stocks. I think it fits within the inflation argument, and it's one of the few things I like right now. You can see the longer term chart. It broke this long downtrend. That's when I started to turn more bullish on gold. Now you're stair stepping up, higher highs, higher lows. The only thing here is that that makes sense that we're also bumping into a little bit of resistance here. So this would definitely be an area where it could pull back a little bit. But yeah, I do like gold, and I'm bullish on gold. Now I am today going to adjust my stops on my gold trade to make sure that I can start to lock in some of these gains that I've already had on the trade. I still want to it's going to be a pretty wide stop still, because I want to give it plenty of room to keep going higher. I think gold's going to trend higher for most of this next year, so I want to kind of let it do its thing. Oil I've been back and forth on. I was talking about this looking corrective right through here. I turned bearish on oil right here, expecting on that bearish reversal. Actually, that was a bearish engulfing that changed at the very last minute, the very end of the day there. This was a key high for me. If it broke above that was the previous lower high after we had gone to a lower low right here. If we get above here, that would definitely be more bullish on oil. We started to move down here, and then we fought it again, moved back up. Then we got the sharp move down. This definitely looks impulsive to the downside. This looks corrective. We've tried to rally a little bit. So we opened higher here, we closed down here. We opened higher here, we closed down here. This is sluggish behavior. It's not looking very strong, not looking very bullish. In fact, it's looking like it's getting ready for another move down. So I'm leaning more towards being bearish on oil again. We'll see if it continues to drop. Based on the way it's behaving, it should take out that December low at some point. And then where would I turn more bullish? I'd turn more bullish again if it can get above this high right here. So the way we're behaving, like I said, in the near term with this impulsive move down, this corrective move, I would lean more towards this next week. Oil eventually moving to the downside. And by the way, this can fit into an argument that if we do get a market sell-off and it's fearful, everything tends to go down. Almost everything goes down, like a sea of red everywhere. And that would mean that oil would drop, gold would drop. Gold's in a spot where it could pull back. Oil looks like it could drop. Bonds look like they could drop. We could see where those things where everything is lining up to drop. We'll see. It could also get squeezed. Dollar's looking like it could drop. Dollar's been now that's usually been more of a inverse relationship lately, where the dollar weakness has been bullish for the market. When the dollar starts to rally, it's been bearish for the market. Had a big sharp move down on Friday. The trend looks like it should continue to move down, although you always can always have these little corrective periods where it tries to rally. But I don't see anything in the dollar chart to suggest a change of that trend just yet. I guess that if we move down a little bit further, you could be in the extreme, the oversold condition where it could be in a condition where it could bounce. But we're still pretty far away from being to the far left side of that extreme range. So there's definitely still room for the dollar to continue to drop here. And that's what the trend is right now, until we see something different. All right, the VIX. This is probably one of the strongest arguments I have for expecting the market to sell off here as opposed to break out. The VIX is down around 20. Every time it gets down around 20, it starts a sell-off. This was where we had the December sell-off right here. And again, we didn't even get to the fear range. That's just basic fear getting up to 30 on the VIX. 40 is panic, and we're nowhere. We haven't been near 40 during this whole year. We never got a spike up above 40. So if you want to kind of quantify what I mean by panic, that's probably the easiest way to do it. And by the way, that's a minimum of 40. Usually most of these panic sell-offs will spike up above 40. But I'd at least like to see a minimum of above 40 to just feel confident there's at least some panic in the selling there. But where, from a sentiment standpoint, where are you going to go? If the market goes up, it can drop below 20. We did right before that big sell-off in December. But where are you going to go? I mean, if the market does rally for a couple more days, it just means, okay, you're rallying for a couple more days, but then you should start to see it, well, not necessarily spike up that big. It could just be another December one where it moves up to 24, 25, somewhere in that range. Is the VIX gotten down below 20 before? Yeah, but it's during bull markets. We're not in a bull market. Now, could you say, okay, this is going to be the one time that you're going to get a VIX go down to 15, 16, that when you're still in a bear market? Again, boy, we can play this game all day long. You want to point out the possibilities. Good luck trying to analyze anything ever again in your life, because everything's a possibility. Is it a possibility that TCU could have come back in the with 2 minutes left in the game down 60 points or whatever? No, there's not a chance in hell. But is it possible? We've seen crazy things happen, and it's like the 0.01 probability, and it's happened. But if that's how you want to look at everything, then good luck trying to analyze stuff, and good luck trying to make money, because you're going to be on the wrong side of a lot of things. Always looking at the possibilities instead of the probability. All right, so I think that this rally is going to be, and again, even if it spikes up, gaps up off of the CPI report, I don't think it's going to last. I think it's going to roll over at some point, probably as soon as earnings start coming out. So I'm still sitting on the sidelines as far as for the majority of my portfolio management, sitting in cash, waiting. All right. SMH, now, chip stocks right here, you could make a little bit of, you got an impulsive move down right here. You could make an argument this is kind of an ABC corrective move, but this is not looking overly corrective. Okay, you could make an argument this is a little bit of an impulsive move. You're right at a 50% retracement, so we'll have to watch it right around here, see if it's does it start to break out above there. Now, this is clearly an impulsive move down, so you had this corrective move, and that gap up satisfied the move higher out of this corrective move. We did move higher out of that corrective move, so I think that was part of this move up here. Could you make an argument that this was wave A, wave B, wave C? Boy, this would really start to stretch the principles of the ABC pattern. Typically, wave B doesn't go above the beginning of wave A. It can on rare occasions, but it's rare, so I don't assume that it's going to do it. Again, you're getting back into probable moves. And then if that's the case, then your wave C is 3 times the length of wave A. Could he have a long wave C like that? It's possible, but definitely not probable. So you start to look at, there's too many things that you're trying to stretch there to make that a bullish ABC pattern. And I would argue if you're trying to do that, I would strongly argue that you have a strong bullish bias and you're only looking for reasons why the market's going to go up in that case. And that could be problematic. You might want to check that because that could be dangerous if you're looking at all the possible moves and not the probable moves. Then that's usually a sign that you have a predetermined outlook and you're just trying to find anything that'll back that up or to prove your conclusion. We don't want to be like that as trend traders. You got to be flexible. And yes, I do have a bearish bias, but I'm giving you my evidence in the class. Okay, I'm giving you my argument in the class, and I'm not afraid to be challenged by it. Some of you have challenged it, and I will show you where I will start to change that outlook. So I'm not locked into it. Now I do have a lot of bearish trades in the form of put option trades, so I do have a vested interest in the market going down. But I've been doing this a long time, and I manage my risk to the point where I don't have a significant amount of risk to where it's painful it'd be significantly painful if I'm wrong. So I don't have a reason to, try to find every reason for the market to fit within my outlook. But this is something to watch. Now, what would cause me to, now, again, the reason why we're looking at chip stocks is they tend to be a leading indicator. They tend to lead the way up, lead the way down. So I'd want to watch where we're at right now, where I think this is a significant point. I think yesterday's range will be important over the next couple of days. You start to get above this area here. You do have a little bit of resistance here. Definitely, if you were to break out above here, you're looking a lot more bullish at that point. So we're getting, we're still in a bearish outlook on this, but you're getting into a critical area here. You've got to start to see it roll over here pretty soon, or it moves into a neutral. There is a range here where you start to become neutral. It's like, boy, it could go either way right here. And we're right on the verge of that with some of these charts where it's still looking bearish, but we're possibly getting into a neutral area. And then you'd have a, breakout above here in a more of a bullish area. Now, the transportation, again, you're comparing this with the Dow. You could make a little bit better argument that this is kind of a bullish ABC right here, and that it could go higher because we didn't go, the B wave or whatever didn't go above wave A. And if this is wave C and that's wave A, it's not significantly longer than wave C isn't significantly longer than wave A. So if you want to make, say this is more of a bullish looking, could be a bullish ABC pattern, you can make that argument a little bit better on the transports. But this is also, again, kind of a critical area here. We'll see how that looks on Thursday. Bitcoin's had a little bit of a rally. Long term, though, it's ugly. It's probably heading lower. I don't see any reason to be too bullish on crypto right now. And I know some of you that will anger you a little bit because, but yeah, I think the FTX thing is the tip of the iceberg. I think we're going to see more of these. Because just the fact that none of it's been regulated, I think there's been some situations where it's been the opportunity to do bad things is there, and human nature is that sometimes when the opportunity is there, that bad people will do bad things, and I think we'll see more of it. Kind of like what happened with the tech bubble. When that burst, you started to see. I mean, basically, if you know how ridiculous the tech bubble was, there were people that all they did was come up with a business plan of a company They didn't even have the company running or selling any product. They just had the plan, and then they were publicly traded, so they got all this money from investors, and they spent it. They bought stuff, and they just lived lavishly. And I'm sure some of them had good intentions to actually start the company at some point. But I mean, there was a lot of bad behavior during that period, and I think we're seeing the same thing kind of with crypto. You see these in different areas. It's a cycle. It happens over and over again. You can go back 200 years and find these cycles where technology took off, and then corruption came in, and then regulation came in, and then the stronger, most well-run companies survived. And I think the same thing is happening with crypto, which is a good thing, because you'll get a better product out of it. But all right, portfolio. I did stop out of SARK. I had SBXS and SARK in case we were dropping off of that jobs report. We didn't drop. Let me take a look at SARK here. You can see. So SARK dropped. I stopped out of SARK. Didn't lose too much there. It wasn't too bad. And what kind of made up for it was that gold and the two gold stocks have taken off. I'm hanging on to SPXS. This is my only hedge right now. This is kind of moving opposite of the S&P 500. You had what was a bearish reversal candle on the SPY is a bullish reversal candle here on the SPX. So expecting that to move higher if the market goes down. I still think that's okay. If we drop below here, if we end up going below here, I'll probably stop out. Because again, the market would move into that neutral area there, and I'd want to be more in cash at that point. I don't want to have a strong directional bias in that situation. On gold, on NEM, well, let me go back here. On NEM, my stop was a wide stop. I had my stop at 37.40, which is all the way at the bottom of the move here. It was all the way down here. I'm going to move it up to 42.20. Was that right? Is that 40? I want to move it up to about right here. What was the low? Let me see what the low of that day was. Yeah, the low was 44.32. Oh, 44. So I'm going to move to 44. Actually, let's just move to 44.30. I want to give it plenty of room to, if this thing pulls back in a deeper way, but I also want to protect some of these gains I've already had, especially on that move right there. Now, this wouldn't get me clear of my entry. I'd still have a loss, I think. Let me double check that here. So my stop below is 44.20. Let's see where that shows up on my purchase price is at 48.63. So yeah, it wouldn't get me to break even there, but it would lessen the loss if I end up getting stopped out, and I'm not right, and gold gets collapses here, then I would want to get stopped out. So I'm going to change the stop price here to 44.20. And now the GDX, I had my stop at 27.50. And which is below this low right here. Actually, I think I'm going to just hold that. I'm going to keep that one there. I was thinking of moving it to here. But I want to give this, and this thing could pull back in that range and still be, still kind of follow that trend line, still could get down there pretty close. I don't know if I want to, because I think that I'm trying to capture a much bigger move. So I want to raise my stop, and I want to give it room. So what would happen then is if we're obviously over in the extreme reversal risk, getting close to the far right side of that. Back to the GDX is very close to the far right side. Now, what would happen is if we did get a correction that moved sideways or corrected right here and then broke out again, had another run like this, then I would look to move my stop below that last correction. So I'd probably wait until it was all the way up here again, and then I'd move it to above the last correction. One of my favorite ways to trail stops. Some people like to do a percentage. I'll do a 10% trailing stop or something like that. Stock drops 10%, I'm stopped out. I like to be, because I know how to read a chart, obviously if it were to give me a higher low and a higher high, I'd want to be stopped out if it suddenly went to a lower low, right? I want to be a little bit more strategic in the placement of that stop. And so that's kind of the way I like to do it. All right. As far as new trades, like I said, I do like gold. What's nice here is if you look under basic materials, look at all the gold and just mining companies. You want to see who's outperforming. There's 37 gold stocks that are buys, only 2 that are sells. Just miscellaneous mining companies, 50 buys versus 6 sells. Definitely a sign that these are trending up, outperforming. But like I said, a lot of them are getting stretched. The gold mining companies here, Yamana, AUY is looking pretty strong. But again, a lot of these are just in that extreme reversal risk range. Just might want to wait for the pullback or consolidation. It doesn't have to pull back. It can move sideways. You might want to wait for that. I like this AGI as well, Alamos Gold. Well, almost all these charts are about the same. I know some of you wondered why I chose Newmont. Newmont didn't have as high a strength rank. I'm just more familiar with Newmont. I've traded a lot in the past, and so that was a little bit more of the reasoning behind getting into Newmont. And at the time, remember, I was pretty early at the time. We hadn't seen the real strong strength in gold yet. I just wanted to get a little bit of exposure to it, and then I added the GDX, which is the ETF. Or if you want to look for individual gold mining companies to trade, you just want to trade the whole group, you can use the GDX to do that. That's why I have that exposure in the portfolio as well. Eventually, we'll add more, and we'll be more active in adding stocks. It's just that it's kind of just waiting for that bottoming process. And the thing you don't want to do, the worst thing you can do, is get wiped out in a bear market or lose significant money in a bear market, because the best time to get in is near a bottom. I don't say at the bottom. We can't know the exact bottom, but near the bottom. And then you ride the whole bull market up. That's what everyone wants to do. But human nature, because you're not patient, you want it now. You want the market you think the market's bottoming now, and you don't want to miss it. You jump in at the wrong time. You get hit really hard. You lose 50% of your capital, and now, you finally capture it, but you spend the first half of the bull market making up for the loss of jumping in too aggressively too quickly. And so I'd rather be late getting into the bull market and be confident that I'm in it than try to predict when it is and just getting hammered. And if we are, and this is another argument too, by the way, if we are if we are going to have a recession, which everything is pointing towards that sometime next year, the market has never bottomed before the recession. And so again, if you're calling that October low as the bottom and we're going into a recession, we're not, that would be the one time where we bottomed before. Now you could say, oh, you don't think we're going to have a recession. Again, you could you could argue that the Fed is orchestrating a soft landing. Well, there again, they've never orchestrated a soft landing. So you're gonna assume that there's going to be the one time in history that they orchestrate it. I don't see how that could possibly happen, because as soon as they take the foot off the gas, I know what human nature is going to do. Greed is going to kick in, and you're still going to have an inflation problem. So there's a lot to this, and I know if you're new to trading, it can be a lot to try to figure out. And by the way, I bring in a lot of fundamental stuff and a lot of my opinions on stuff. The bottom line is I'm a chart reader. I'm a technical trader. I like to bring in other stuff to help kind of explain what I think is showing up in the chart. But if you don't know some of these things from just not trading very long, and what the Fed tends to do and not do, and how they tend to screw up a lot of times, and don't worry about it. Just focus on reading your chart patterns, your trend analysis, and your candlesticks, the price action of the day. And then you'll get the other stuff just by trading long enough. You'll soak in and experiencing it. Remember, I've been through a number of these cycles so that's why I know what a bottom feels like and looks like and acts like. I can tell you, but until you experience it and you say, oh, that's what a panic sell feels like, then you don't have that. You don't have that experience yet. You'll get that. But the most important thing is just being able to read the chart. Yeah, I explained that on gold. I told you that although I like the trend of gold, that I expected it would consolidate or pull back. You might have asked that question a little bit earlier. I don't know when you asked it, but yeah, I am bullish on gold, but I think it's because it's in that extreme reversal risk, it's probably going to correct. So I wouldn't be jumping in. I'd keep some of these gold stocks in your watch list though, because you want to be ready when they do correct. But yeah, I'd wait a little bit here to see if they can and they don't have to pull back. They could just move sideways a little bit to consolidate. All right. Thanks so much. Sorry I went a little bit long today. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.